Buying a house in Australia is the ultimate dream for so many people, but how achievable is it in one of the most expensive housing markets in the world? Well, to help you out, I spoke to a senior mortgage broker and the director of a mortgage company with over 50 years of experience, and they've helped thousands of people to secure in total nearly $1 billion worth of home loans. Ben will also answer your questions submitted to us via Instagram. What do you need to do to prepare yourself to buy a property down under? I guess we'll find out. G'day Ben, how's it going?
Mate, good. How are you?
I am very good, very good. How is the weather down in, well, it's not quite Sydney, is it? Newcastle.
Yeah, just a little bit outside of Newcastle. Look, it was cloudy, but pretty warm today. So still really good, still close to summer. Not too cold just yet.
We've had it pissing down. I've decided that in Australia, and perhaps you can tell me, because you're an Australian, the weather in February, March is the worst of the whole of the year. That's the worst part of the year, I reckon, particularly in Brisbane.
Well, I suppose you would be used to the cold as well. A lot of Australians probably think something a bit colder would be the worst of the year, but you're probably more used to that type of temperature.
I've been here for 3.5 years. I'm not used to any cold anymore. It hits 21. I think it's freezing. The long pants come out. Ben, you are here to talk to us all about home finances today.
Yeah, that's right. See how we can help people. We can offer some advice and how to buy your first home, investment properties, all things in between.
Perfect. So for those people who don't know, can you tell us what a mortgage broker is and how can you help people with their move over to Australia?
Yeah, so a mortgage broker is basically just someone who's going to be there to help and support you through the entire process. So from the very, very start, when we're trying to figure out what you can actually afford, what the repayments are going to look like, and then that sort of flows on to where you're going to buy, and then all the way through picking different lenders, doing the applications with you, working with anyone else we need to work with as well. So your accountants, solicitors, financial planners, anyone like that, basically bringing everyone together all the way through to the settlement of the purchase and then ongoing as well. We always like to check in, make sure everything's going okay, and see if we can sort of help change things, make sure the rates are good, make sure the structures are right in the future.
Then I guess for someone who is new to buying houses or even new to buying houses in Australia, what do you reckon the common kind of pitfalls are for immigrants when they move here and how can they be avoided?
A common one for people coming over and really just in general is often we see a lot of people trying to wait and save more and more of a deposit. The one big key that I see a lot of people do is they think, well, I've got to save enough of a deposit to not pay for the lender's mortgage insurance. So that's basically 20% plus the costs which can get quite expensive if there's stamp duty and things. Whereas if you look at over time, the people who get in faster and then they can gain some of that momentum and be in the market, get any capital growth between now and then, you're often going to look a lot better on paper in those next couple of years. It's just taking too long to save those bigger deposits, and the market in Australia especially just gets away from you way too quickly. The old saying, time in the market, not timing the market. The sooner you can comfortably get in, afford the repayments, that's the time really to get in.
So for those people who don't know then, can you explain the process and what requirements there could be for obtaining a mortgage? Or they don't even call it a mortgage sometimes, do they? They call it a home loan in Australia.
Yeah, home loan. Technically, I think the mortgage is the part that actually secures the bank to the property. You're going to have the loan. So typically what we do to start the process, we just want to understand where you are at the moment. So that includes all of the incomes, your expenses. We want to try to get a budget put together, and then from there we can set what the budget or where the purchase price is going to fall. That's always the first step. Sometimes people do that a little bit reverse. They go and they find a place, they fall in love with it, and then they call you, and then we have to say, look, it's probably a little bit outside your budget, that one. So that's always the first starting point. Once we get that budget set, we can pick some lenders to choose from. We go through the different options, etc. And then once you're ready to actually look for places, make offers, that's when we'd put the application in and get a pre-approval. So that's the big first step, getting that pre-approval to make sure that you're confident you can get the money and make those offers.
Are there any restrictions or additional costs for foreigners or people perhaps on a temporary visa when buying property in Australia?
The visa requirements are very different lender to lender. So not all lenders are going to be able to lend to you if you are on a temporary visa or any of the bridging visas. Typically, the bigger lenders do like to see that there is some longevity to the visa. So I believe some of the visas might have short and medium terms to them. You want the medium and the longer terms where possible. So visas are very specific to lender. So it's always good to check that up front. You can still buy property if you haven't got the visas in place yet, but you end up in the non-banking sort of world. So expense-wise, it does start to really get quite expensive. You'll get things like the stamp duty. I believe it's different state to state, but it's around like a 7 or 8% loading to the stamp duty if you're not. If you don't have like your PR, for example. And then you may also need to go and get Foreign Investment Review Board approval, which it's for what we're sort of talking about in the context of buying a home or buying an investment property. It's not the approval that's the worry, but there's a timeline of about 30 plus days to get the approval. And then there's a fee that at the moment, I believe, is around about 15 grand for a sort of standard type of property. It does escalate if we're talking about bigger things. So it can be very expensive if we don't yet have any of the PRs or the permanent visas set up yet.
And you talked about stamp duty. I know we had that in the UK, but can you, for people that don't understand or know, can you explain stamp duty and any other additional costs that might be associated with buying a house? Because I know that a lot of people, they'll look at a house and they'll say, I don't know, this is $500,000, but they don't really ever think about the additional costs on top of that might make it prohibitive, particularly if it is a more like that's at the top of their budget.
Yeah. The stamp duty is really quite an important one to make sure we keep factored in. A lot of people will talk about what kind of deposit is needed for a property, and you'll hear numbers like 10%, 20%. They're missing the big component of that, which is the stamp duty on top, which is basically just a one-time fee that we have to pay to the government. There's sort of a couple of different parts to it. It might be stamp duty in some states. There might be another one called transfer duty in Queensland, and then a couple of smaller little registration fees. We sort of just wrap that all up into the one when we're talking stamp duty. But again, for example, in New South Wales, you're probably going to be somewhere like 3 or 4% of the purchase price you'll have to pay on top, which will be quite a large one-off fee considering where property prices have gone. So if you haven't budgeted for that, if you haven't factored that in when we're looking at how much you can afford, it can really add up. There are potential concessions and waivers that you can get if you are eligible to qualify for any first homeowner benefits. Again, that would include things like, well, you'd need to have your PR set up first. And then you could have some concessions. Just they change again state to state and depending on how big the purchase price is, but they can be really quite beneficial because if you haven't factored in an extra 4% and you're just scraping together as much of a deposit as you can, it really will just completely change your ability as to how much you can afford.
Well, not awesome because it means you have to pay extra money, I guess, but great to know. Great to know. Sometimes it's a thing that I think, particularly if it's the first time you purchased a home, you don't really think about it. You just think, I've got to pay the price, mortgage kind of related fees and things like that. And yeah, you kind of get stung and you think, oh, hang on a minute. Now, I know in the UK, there are certain incentives, particularly when I bought my first house, it was because of the price of it. There was things like stamp duty exemptions. Are there any other kind of government incentives, perhaps even like that might be available for people who are first home buyers in Australia?
Yeah, definitely. There are some. So stamp duty concessions is one. You just have to watch for the purchase price brackets as to when they click on and turn off. Unfortunately, again, where property prices have gone, if we're talking about New South Wales in particular, it's very difficult to actually qualify for some of those. So stamp duty concessions is one. You can potentially get a grant, and state to state, these amounts are going to change. But the big thing with the grants is that they are targeted towards new builds. So this is where the government is trying to incentivize new developments, new dwellings. And so I believe in most states, it's about $10,000 you could get if you're buying a new place, a brand new build or an apartment or whatever it is. And then in some states like Queensland, they're really trying to extra incentivize builds. So I think at the moment you can potentially qualify for up to $30,000 if you are building a place or if you're the first one into a new build. That if you can get that, if you can qualify for that $30,000 plus you can get some stamp duty waiver, you're sort of starting to get around that $40,000-$50,000 worth of either concessions or cash bonuses. So it can really sort of stack up that. There are some other little different schemes around as well. They would mainly be targeted towards people that have small deposits. So again, typically first home buyers, they may not have the biggest deposits. But if you're coming from somewhere like the UK and maybe you had a property there and you've sold that and you're bringing some cash over, these ones may not necessarily be as relevant to you. But essentially the government are happy in certain circumstances to be a guarantor for your loan. And so if they're going as a guarantor to your loan, what that means is, the long and the short of what that means is that you don't have to pay for lender's mortgage insurance. Lender's mortgage insurance is another one of those costs or fees that not everybody takes into account. And so to sort of run you through what that is, if you have anything less than a 20% deposit plus the cost, so again, if we're talking stamp duty, always make sure we're going to bring that in. So 20% plus the costs. Anything less than that, and the lender is actually, they have to take out an insurance policy, which is against you and it protects them. So it's an important distinction that it sounds like an insurance policy. You think, oh, well, look, I'm going to pay a big fee, but at least, I get some insurance for it. Unfortunately, it's not the case.
It's not your insurance.
The bank. It's not your insurance, even though they make you pay for it. And so again, that's a sliding scale depending on how much deposit you have. But let's say as a worst case, if you're in the bracket of I have the smallest possible deposit, then it could be 3 or 4% again. So now we're looking at those outside the purchase price costs, and all of a sudden we've gone from 4%, now we're 8%, plus the deposit you had to come up with in the first place. If we don't get those numbers right, it can really stack up very quickly.
I guess there's a lot of things to consider with regards to deposits, and the message we're kind of hearing is, whilst it's not important to get the biggest deposit possible, there are some kind of minimums that perhaps you'd want to take into consideration, otherwise there could be some extra costs. But I guess another question that commonly gets asked is, how do you build up a credit history in Australia, and how important is that with regards to buying a house? Because I know, coming from the UK, that was something that was really quite taken into consideration, and that can sometimes mean that you get better mortgage offers.
Yeah, Australia is actually slightly different to the UK and especially to the US when it comes to credit scoring. So the way a credit score works here in Australia is that you're actually assumed to be at the top until you start to mess it up. So you don't necessarily actually have to go out, and it's a little bit of you'll get different opinions from different finance professionals on this one, but you don't necessarily have to go out and get a credit card and prove that you can pay it back and demonstrate history of a debt like that. Not like you sort of have to do in the US, and by the sounds of it, maybe in the UK, if that was a thing. It's a bit of an old school thing. Like maybe 10 years ago, I have seen in the past, in a very specific set of circumstances, a lender say, look, there is no credit history, so we're not comfortable. But there's a whole other set of circumstances towards that. For the most part, you don't have to go out and rush out, go get a debt or anything like that. You start with a high, clean slate in Australia. What happens is, let's say now you do have a debt. If you do get a credit card, most lenders are doing what they call positive credit reporting here. So every month that you pay your debt on time, they mark you down as paid. And that'll come up for the next 2 years, anything that you've got, any kind of debts. If you get behind by 1 month, they'll mark down as 1, 2 months, 2, 3, 4. It just continues on. So the longer that goes out, the worse it looks, the worse the score gets. And then again, the lenders, in terms of the home loan lenders, they just don't want to see any missed payments of any kind. In lots of ways, you don't, again, want to rush out and just go get a debt just for the sake of having a debt if you're going to sort of risk potentially missing one. And when I say missing one, a lot of the time when it gets missed, it's something like, I had a credit card, I didn't use it, and then they charged me the annual fee onto the card and I didn't even know. And then it rolled through to a month and they think that I've missed a payment, but really I just didn't even use the card. That'll be on your credit file for 2 years.
Yeah, it sounds completely different to the UK, because I know that one of the things that some people, they grow up and they get told, don't ever have credit cards and things like that. It's not a good thing because of how the repayments can stack up if you start using them. But one of the things you then get told is, but it's a good idea to build up your credit score. And I guess for someone new moving to Australia, it's great to know that you don't have to worry about it. It's one less thing to worry about.
When it comes to credit cards, I mean, there's a lot of psychology behind it as well. More so, like I don't think that. Well, there are certain personality types that perhaps don't fit credit cards. Um, there is, however, a time and a place for them. If you're happy or you're able to manage them effectively, especially if you've got a home loan, they can be very effective. So, to give you a quick run through of how you may use that in an effective way, if you did have a home loan, what you would then be able to do is say, keep as much money aside, either in the home loan or in an offset savings account, which we can sort of run through how that works a bit later. And that essentially means that all the money you've got aside, that's going to keep saving you interest on a home loan. You then use the credit card to start to pay for all the bits and pieces that you need day to day. And typically a credit card would have a maybe, let's say, 55-day interest-free period. And you might have one that gives you some frequent flyer points or rewards points or anything like that. The theory and the strategy is that you keep as much money in the home loan, saving you interest. You use the card to gain as many points as you can, but before any interest is charged, you take the money back out of the loan, wipe the credit card, don't pay a cent of that interest, and then maximize basically the interest saving and your points that you're getting. The big problem is the psychology is that people don't wipe the card. So
Yeah.
it works on paper. It can work very well if you're disciplined, but I just wouldn't rush out and do it unless you know that you're going to stay strong.
Don't get a card thinking it's free money. It's just another way of using your debit card, but you just use that card instead, I guess.
Yeah, and I don't understand why in such a regulated financial environment that we're in, like banking in general, finance, mortgages especially, are under such heavy scrutiny. You're only allowed to have a 30-year mortgage, but they give you a credit card with a minimum repayment. And if you have a look on your statement, it'll tell you by making the minimum, it'll take you 80, 90 years to pay off. How is that allowed to have a debt that will take 90 years? It's just, I don't know how they get away with it.
I don't even think the average life expectancy is that long yet. So yeah, I don't. It sounds like the student loans in the UK, where if you don't pay it off, they just wipe it anyway. Oh, well, if you die, then you don't have to wipe it off. Well, we've done a lot of help for people who are new home buyers, but I guess if there is anyone out here listening that's perhaps been in Australia for a while, or I don't know, those really rich folk that seem to be coming from abroad and buying up all the properties in Australia, you pesky people. Let's talk about investment properties. And I guess, what role do investment properties play in the Australian housing market? Is that even a viable option for newcomers?
Investment properties in Australia are, again, you'll get a lot of different opinions on this one, on whether or not they're the cause of the housing price issues that we've got, or the rental crisis that some people will like to talk about. It's used. Investment properties are used very heavily as a wealth creation tool, more and more so as we go forward. Especially, I mean, at the moment, if you're into property investment and you're looking at different places, you're no doubt hearing all kinds of things about Western Australia. Everybody's pushing you into Western Australia. You can get these cheap buy-in prices. You generate equity over a short amount of time. Take the equity out, buy another investment property. This is the strategy that so many people want to push at the moment. And it does work as long as you're in these right suburbs and you can get that equity growth. The strategies definitely work, but it is potentially making it a little bit difficult for first home buyers. So it plays sort of a double-edged role in that way. Investment properties. So in terms of if you've already been in the country, you've got a property already, and you're looking at buying an investment property, there's a bunch of different tax advantages that comes with. And that's one of the main things that investment properties are sort of pushed for, is you get negative gearing, or essentially you can write off the interest and other potential expenses that come with the investment property. You can write that off against your income, and you can save quite a lot on your tax, whilst at the same time buying assets that are increasing in value. So the system is designed to support investment properties. You get a lot of benefits from it. It is the natural sort of progression. More and more over the years, they've started to be used as well from a first home buyer perspective. This is probably especially in places like Sydney, where the average home price is over $1 million. So a lot of first home buyers can't actually just buy a home there anyway. So what they're doing is, you may have seen again a term called rent vesting, where people are renting where they want to live, and then they're buying investment properties elsewhere. So two very different strategies there, but it's just about trying to get into the property market, which in Australia, again, if you look historically, it just continues to be supported in so many different ways. I think the fundamentals of property really being supply and demand in a country like Australia, and especially this is what's a big part of what pushes Sydney, is there's just not enough supply and there's so much more demand. There's so many people continuing to come in, and the planning system, the building process in Australia is far too behind. Yeah, investment properties definitely play a big part in lots of different ways. And the strategy will be different whether you're, again, a seasoned investor, or maybe you're just starting out, or even if you're a first home buyer looking to rent vest. So lots of different factors you take into account per the different strategy.
It seems to be the case where I know that they've let in a lot of health professionals over the last year or so. Teachers, I know, has been another profession that they've let a lot of people in. I think they need to re-look at their migration strategy, and perhaps anyone that is in any part of building whatsoever, that needs to be the green lights to do it. Because, I think that's the main problem at the moment, particularly with house prices, is, if there's not enough supply to meet the demand, and there are more and more migrants moving in here. I mean, Australia needs the migrants to come in to support the economy. We just need to perhaps bring in some more that can then build their own houses for themselves.
Yeah, and especially
like the olden days when they used to come over and build their own houses.
just build your own when you get here. Yeah,
it. It'd be fine. It would be fine.
The planning system in particular, there's just so many bottlenecks to even try to get a single dwelling, a single house built. There can be huge restrictions to it, let alone trying to build, these big housing estates or big, tall skyscraper style buildings close to all the cities and things like that. But I mean, there's always talks about different ways to fix things. They talk about zoning changes. They talk about density restrictions, but it just doesn't actually happen. And the lead time, I mean, even if they approved a new building today, you've still got years before there's any real change in the available dwellings. And at the same time, again, we're just more and more people come in. So hard to see when that stops.
I'd like to think that they're trying to think of something. It's definitely a big thing in the news at the moment, and I hope they just don't end up being like the UK government, where nothing ever really gets changed or the wrong thing gets done. But we shall see. It's not we're not talking about politics necessarily. So thinking about people who do move from abroad, and perhaps they think to themselves, I'm not sure if the move to Australia is going to be a long-term thing. I've got a property back where I live. I'm not sure whether I want to sell that yet and make the full commitment. Do you know how immigrants to Australia might make the most of their financial assets from their home country?
In terms of using some other assets you've got overseas to then buy potentially here in Australia?
Yeah, is that a thing that can happen?
It's a tricky thing. There's two sort of aspects, really. If we take the lending criteria down to two bits, we're talking about income for one, and then you're looking at deposit mainly. It's the two big ones. So deposit-wise, it's for the most part too difficult for another lender here in Australia to gain any kind of security of a property or over a property that's over there. There are, again, sort of rare instances where you might have a big international bank like HSBC, where they've got a presence in lots of different places and they'd be comfortable to do something there. But for the most part, it's just going to be too tricky. The income that it generates, again, particular lenders, that can be taken into account. So that can increase your borrowing power. If you do have any debts associated with it, same thing, that also gets taken into account. So whether or not that's a benefit depends on how it's set up, but that would be the main way, I would think, is the borrowing power that it can bring over. There are some tricks to using income when it's what you would classify as foreign income when you're in different currencies. Essentially, it gets buffered down quite a bit. It gets converted over to AUD. It gets buffered down to 80%. And then it gets put into the standard calculators, which would probably buffer it again. So they're very conservative. But again, if you don't have a big debt associated with that income, then we could potentially just use that income to help push up your borrowing capacity. And given where interest rates are here in Australia, any extra borrowing capacity is going to be a good thing.
Okay. So it sounds like whilst it's not the end of the world, it probably, if you're going to make that decision to purchase a home in Australia, it probably would be a wise option to, let go of that one, perhaps where you came from.
Yeah, if it's going to free up deposit, that's going to get you into the new one. I mean, if there was a situation where you could get some equity or access some funds before you came over by using that property or in another way, and then bring that over as cash, then we can start to talk about, well, that's actually now just a cash deposit that we've got. We're not trying to secure a loan against that property in particular. It depends on whether or not you need to access more cash is probably going to determine whether you sell that property or not.
I guess then, thinking about the future for anyone who is new or thinking about coming over in the near future, how has the Australian, I mean, I've been here for 3.5 years and it's changed a lot, but how has the Australian housing market changed in recent years? And I guess what could be the short-term projections for the near future?
Yeah, it's changed quite a bit, particularly over the last 18 to 24 months. You would have seen all the talks of interest rates and inflation in the news. You've got building costs as well escalating, but then at the same time you've got builders collapsing. Essentially, what that has done is it's put pressure on costs. So costs have gone up, but it's also put pressure on borrowing capacity, and that's the really big one. If we talk about 2-3 years ago, there was some emergency COVID money basically put into the economy. So people were able to borrow at interest rates of sub 2%. You might have a 1.8, 1.9% interest rate. Fast forward today, that same loan is about 6%. So it's been a gigantic increase in the interest rate. I don't think they've ever raised them that quickly in history. Potentially back in the 80s, although I still don't know if it was that fast. And what that does is it's put just so much pressure on affordability that people just were too stretched and couldn't actually afford to pay the prices anymore that they needed to. So there was a period where things started to come down, but sort of what I alluded to before, a property in Australia just always seems to be supported. And so if we now look a little bit shorter term, if we talk like 6 months and we look at forecasts for this year, prices are being supported again and people are back in the market. We saw towards the end of last year, a lot of investors were selling off properties that were getting too hard to hold on to, but then they just redeployed that capital into different properties again. So property in Australia just seems to be, it's always supported by something. It just continues to go on. Interest rates are typically always linked as well to house prices. So it's just around affordability. The more you can afford to borrow, the more you can afford to pay. People will just keep doing that. They'll get emotional about buying homes and they'll keep pushing and pushing and pushing, depending on the forecast. So if we sort of take the average of the big 4 banks here in Australia, it's looking like toward the end of the year, we may get some interest rate cuts. Things may start to come down into 2025, maybe into mid-2025. We might have maybe up to 1% off the interest rate. So that will directly affect how much people can borrow. And you can sort of, if you look back historically, you can really only assume that it's going to continue to support property prices increasing again. Apart from some kind of heavy unemployment issues, that's probably the big one to keep an eye on, is the unemployment numbers. But as of, I believe, last month, that's still not creeping up. Like the unemployment rate isn't creeping up. So people have scraped together all the money that they could. They've had big savings accounts through COVID. They've managed to keep making their loan repayments. They're starting to pay more again for properties. There's just a lot of signals that point to it's going to continue to increase, not necessarily spike or anything like that, but we can't really see any downward action at the moment.
It seems like investment in property or just getting on the property ladder never seems to be a bad financial choice.
Yeah, and that's where we always come back to that. Look, it's as soon as you can comfortably get in and you can afford the repayments, it's about just getting in when you can get in. It's not about trying to time it. We had a lot of clients trying to time it around COVID because people thought, hey, there's going to be a massive big uptick in distressed sales, the market's going to crash, and it went the complete opposite way. And if you were out of the market even for 6 months, it in real terms cost you, depending on where you were wanting to live, it could cost you $150,000 worth of missed equity. And we had people just selling out of their own suburb and then having to move away, like move out a couple of suburbs because they just couldn't get back in again. It's a risky game. It can go the other way, of course. A lot of people in the northern beaches of New South Wales, they did extremely well when those property prices spiked. But yeah, if you get it wrong, you can just be you can be very, very out of pocket from that.
Well, if you're looking to move to Australia, or you've just started thinking about moving to Australia and you don't know where to start, then the first step is to find out if you even qualify for a visa. Contrary to what most people believe, Australia isn't just one of those countries that lets anyone live here. And when we made the move more than 3.5 years ago, it was one of the hardest things we've ever done. To help you out and to plan exactly what you need to do next, speak to the sponsors of our podcast, True Blue Migration Services. And when you mention us, let them do the hard work for you in overcoming the ever-changing Australian visa system. And you get to use their free visa assessment so they can tell you exactly what you need to do to live your best life down under. They are the only MARA-registered visa agency that we trust. And if you don't believe us, you can bore yourself by looking at the hundreds of positive Google reviews, but I wouldn't really recommend it unless you need help falling asleep. If we didn't use a visa agent, we'd still be stuck navigating the minefield of all the different forms and processes, and I probably would have never made the move over here and ended up being one of those people that applied for a visa to Australia and had it rejected. So speak to them today and you could be one step closer to living your best life. Now, you've given us some great advice about mortgages and getting into the property market in Australia. Before we move on to some other kind of user submitted questions by people who follow us on Instagram, what is your top mortgage advice for someone planning to move to Australia and settling down and buying a house?
Yeah, there's probably two parts to it. The best place to start is always about trying to get the budget correct. We're just trying to figure out where we are today, what we can afford, and what we have to do in order to get where we want to go. So that includes trying to figure out what the budget's going to be when you move over, because things are going to change. The costs of everything is going to be different. That could include as well how much deposit you're going to have, like to what we talked about before. Are we going to have to sell something else or not? And then the big one then becomes, well, can I get a permanent visa? Is there what's my path and what's my timeline to something permanent? That all I say it's two things, but I'd bundle that into the one to just say, look, we need to start thinking about it straight away, because some of these things are going to be long term. You know, if you have to wait for certain visas to come through, if you have to sell a property over there, I know the sale process can take some time. So the sooner we can start that, the sooner we can be ready. And then the sooner we can be ready, the sooner we can sort of get in. But the long-term planning process there. So the sooner you can start, the better.
Okay, let's move on to some of these questions. The first one is from Rianne. I think we've already kind of covered it, but just remind us again, are there any ways to reduce the 20% standard deposit?
That common question we talk about, the 20% is a great figure to get to. If you can get to 20% plus the costs, then you can avoid paying for lender's mortgage insurance. But at the same time, it's not the end of the world if you've got less. If you can get to 10% even, that will still not cost you too much in mortgage insurance, but you can get in sooner. And that's what it's always going to be about. If you can qualify for any kind of government assistance, again, all the better. We'll save that mortgage insurance, but I would avoid trying to say, let's put our purchase off for 12 months so I can save another 30, 40 grand, because the property that you're going to buy has probably gone up 50 or 60 grand. And so you're still going to be behind the curve. 20% is not the end of the world. I mean, sorry, as in 20% is not the only thing you have to aim for.
This one's from Cars. I'm assuming that's a version of a name. What's the minimum employment time needed before you can buy a property, or before you can even be kind of considered for a mortgage?
Yeah, this one can be very different lender to lender, and it'll be slightly different depending on your situation. But let's just assume that we're coming from an industry in the UK, and then we're coming to Australia to do the same job, same role. We've got a couple of years under our belt. For some lenders like CBA in particular, they're happy to give you the money because of that employment history after you've essentially got one payslip. So even if you're on probation, if you've got all these other things, they'd still be happy to lend you money as long as everything else stacks up and it makes sense to them. If you wanted to be safe and you wanted to say, well, I'd like to have all of the options available to me, then typically it's about 6 months, because that would get you out of most probation periods. It's the probation period that gets a lot of people. It's just too easy for employers to sort of terminate your contract in that time. So some lenders do find it a little bit too risky for them. But yeah, so
I guess it depends as well on individual employers. Whatever their probation period is for you, that's just get through that bit. I know some places, sometimes it's been 3 months, but I guess it just depends on where you're working.
Yeah. We've even had customers in the past where they've been able to negotiate as part of their package to come over, just no probation period. In which case, again, you can move pretty quickly at that point.
As long as it's all in your contract. Cool. This one's from the Great Emigrate. This is something which I guess I never really considered when I moved here. Is it cheaper and or easier to buy land and build, or just to buy a property that's already made for you?
Yeah, there's a lot of ways to look at this one. I definitely wouldn't say it's easier going through the build process, especially if we look back the last couple of years where some builders have run into some problems when it comes to costs and cost escalations. You can qualify again for certain grants, so you may get the 30,000 if you're building something up in Queensland, and if that 30 grand is what's going to tip you over the line of being able to buy a place, then that's a factor that we definitely need to take into account. And you can afford to either just buy an established property somewhere that you'd like to live, you're happy with it, versus if you want to go through that whole land and building process, it'll always be much easier to buy the established property. And there are other benefits around that too. So when you do build a property, you've got to still buy the land first. So now your debt turns on, and then all the way through the build, what happens is your builder will have what we call progress payments. So every time they do something, a milestone, let's say they put the slab down, that's a milestone. They get the frames up, that's a milestone. They'll ask for some money from the bank. So every time they ask for money from the bank, your loan goes up, and your loan goes up, your repayments go up. So you've got to factor into the equation that you're renting somewhere and living, and now you've got a debt as well. You can't live in that house yet. It could take you, add some delays here and there. It could take you 12 months before you can actually move in. You've got to have some buffer cash available for that as well. An established place, again, you can sort of go straight in as long as you can afford to buy that place. There is another benefit that we like to talk about with established properties that is not for everyone, but I think it's a really good strategy, is that you can do your own improvements. So if you build or even buy brand new, you're pretty much maxed out. Like the property is as good as it's going to be at any one time. It sort of just goes down or depreciates from there. The land value will go up, but the building itself, typically that will just start to come down. If you buy something that's more established in an established area, maybe it's just a little bit tired, it's a little bit older, you can really add a lot of value by doing a lot of those touch-ups yourself. So they don't have to be anything complex. Paint, flooring, landscaping, little things like that you can do over time. The reason we like that is because that's where you can manufacture equity, or what we like to call manufacturing equity. While an area is growing, when the capital growth in an area is going up, if you were to think, oh, my property's gone up in value, maybe I'll sell my house and I'll move somewhere else. You've got to remember that everybody else's house has also probably gone up that same amount, if not more. Right, so you're not getting in front at all. If you've got an established place and you can add or manufacture your own equity, what you're effectively doing is stepping up a level from where you would have normally been. That's actually the more powerful strategy that we like. It's a little bit more, there is a bit to it. You've got to do the renovation work. It doesn't fit with everybody's lifestyle. But it's one way to really creep up and up and up, is to try to manufacture or take control of that growth yourself. So there's pros and cons to both. And I'm not trying to say don't buy land and don't build. I actually quite enjoy the building process myself. I like watching them. I like going to site and checking it all out, but it adds a lot of complexity. It adds costs, especially holding costs. And if something goes wrong with the builder, I mean, probably maybe about a year and a half ago when we had some construction going and builders were starting to struggle, the builders literally just had to stick their hand down and say, hey guys, if you don't give us another 15, 20 grand, we're going to go bankrupt and you're going to end up with half a house.
With no home.
And so what do? You're stuck. You just have to go with that. So there are risks to it, but there's pros and cons to both strategies for sure.
I guess if you are moving over here and you've got all of that stress and you are looking for somewhere to live, then sometimes it's not necessarily the best idea to add additional stresses. But if you are fortunate enough that you've been able to move here and you have somewhere to stay, then that does, I guess, open up some different options to you. Here's one that I'm not sure if we've fully covered from I don't even know how to pronounce that. Can you buy from offshore? So I guess if we're thinking about those people who they perhaps have moved with an employer, like we said before, and they haven't got a probation period, perhaps it has got permanent residency attached to it. could they essentially buy a property before they even get to Australia?
Yeah, absolutely. You can, if you've got all those things, like you've got the job, you've got the income that we can easily show. It doesn't even have to be in Australian dollars yet, and you've got, let's say you've got PR as part of that employment contract, then yeah, you can buy as soon as the income and expenses allow you to do so. So we have sort of the other way around. We've got Australian expats overseas, and they want to continue to invest in Australia, and they might be earning USD or something like that. You're still able to buy whilst you're over there. We just have to remember they're going to buffer the income down. So they're going to convert to Australian dollars, take it down to 80%, and then put it into a calculator that will tax it as if it's Australian. Once you filter all that through, it will be limiting, but it is definitely possible. And if you've got some cash behind you, you had some other assets that you sold, you may not need that much of a loan to secure something. Yeah, it's absolutely possible. Further to that, even if you're staying over in the UK for a little while, you might be there for the 6 months, 12 months, with just whatever the job entails. You could buy the property now and you're going to rent it out just to get some cash flow in. That rental income, that assumed rental income, that also counts towards your income for the borrowing power. So a lot of factors to take into account, a lot of different incomes. You'll get buffered on some, not on others, but it's definitely possible.
We've talked before, this one's from Meet, Monk and Bear. We've talked before about deposit kind of percentages, but I guess what's the ideal mortgage payment to income percentage?
I try not to put a percentage rule of thumb on it too much, but if you were to look around the place at different sort of, we'll call them experts or commenters on this type of thing, people like to see around about 30% of your, let's say, pre-tax income. Another way to look at that is if you take the tax off, that probably goes to more like 40-45% of your income. But it's difficult to then factor in all the different costs. So if you've got kids or other debts and things like that, like what a better way to do, or a better way to run that, would be to do a full comprehensive budget of what you can, or what you do at the moment, and then look to find where there's any wiggle room on things that can be cut back on. Right, let's just try to get to a bare bones basic budget to start with. We can then do some example loan repayments on top of that, and then we'll factor in some buffer. So we might add 1, 2, 3% on top of what a mortgage repayment would be. It's more about the safety now. We're trying to just make sure that you have wiggle room in the budget, and the mortgage repayment itself that we're setting up has enough scope to increase by 1, 2, 3% is a lot at the moment where they are, but enough scope to do it that way. I prefer to do it that way than just use a rule of thumb, 30%, and leave it at that. I mean, again, not to say that 30% is not a bad idea, but we could be a bit more comprehensive about it, I think.
Here's one that I wasn't too sure about, particularly when I bought a house in Australia. This one's from Life of Jade. Can people pull out of house purchases last minute? Or how does that work? Because in the UK, typically, that could be a massive problem, like particularly when there's a chain purchase. If one buyer pulls out, the whole thing falls apart and then you're essentially starting from the beginning. How is that different in Australia? How does that work?
Yeah, I'm glad we don't have too many big chains like that. They can happen, but it's not all that common.
The biggest chain I heard of in the UK was 29 houses.
29 on
29 different buyers. I'm buying this one, I'm buying this one, 29. Yeah, imagine if one of them just went, and it's quite common to just go, no, sorry, there's a difficulty, we can't afford it or whatever. So can people pull out? How does that work in Australia?
Yeah, if you pull out of a contract in Australia like that, right at the last minute, you lose your 10% deposit automatically. And I believe if they really want to, if they suffered some catastrophic loss because of that, they could come after you. And if they want to put the effort in to sue you for it, they could come for more. So you definitely don't want to be pulling out. You don't want to be pulling out towards the end. There are different safety controls within the different contracts in the different states. So to use New South Wales, for example, typically once you have agreed to a price, you could sign a contract. And you may get what we would call a cooling off period. They can be 5, can be 10, could be longer, 10 days, could be longer than that. It just depends what you negotiate. The automatic is 5. Within that 5 days, if you pull out, you only lose a small amount of money. So that's sort of your time to really make sure, look, if we're going to go here, we're going to go. Because once you get to the end of that 5th day, you're fully exchanged and you really want to get to that settlement date, or you're going to lose at least 10%.
So it's not a common thing then, really, that people pull out of property buying in Australia?
It's not, unless it's from some of the big investors or developers. Like they will put down, they've got a lot of money to throw around. I've seen them put money down, very willing to lose 10%. So it's a different sort of context to what we're talking about. Typically in this sort of a scenario, we would do everything and anything to not pull out. Even if you didn't want to hold the property longer term, you would settle on the property and then look to maybe offload it later. Don't just pull out and lose your 10%.
Lose money for the sake of it.
Yeah.
This one's from Heather Lauren. I guess kind of thinking about that idea of, can you buy properties offshore? Some people are concerned about the whole buying process or want someone to be able to help them. Is a buyer's agent a thing, or do you deal with buyer's agents frequently?
Yeah, buyer's agents are a thing. They're not as popular here as in other countries. It's sort of a newish industry here. There are a lot around. The problem, I think, currently is that the industry may be still a little bit too young. And so there are buyer's agents who are basically just getting kickbacks from developers. And so it's not a true buyer's agency. They're sort of just property spruikers in a way. And we do unfortunately see that a lot in our industry, because they want us brokers to be selling these products, and then they'll offer us a kickback, which of course we don't want really anything to do with that. But there are good buyer's agents out there, especially if you're overseas and you have no idea where to start, and you're looking for a service that can try to be a lot more in depth with what they're explaining, like what the suburbs are like, what all the different amenities around the area are like. So yeah, there definitely are buyer's agents out here. You've just got to work hard to try to find a good one, one who will give you a lot more than just, hey, this developer built a block of units, you should buy this unit.
This one's from Connor Bradbury, and I guess I don't think we've actually really answered it yet. If you own a home abroad or have owned a home abroad, are you still a first home buyer in Australia?
Yeah, absolutely. The first home buyer regulations only stipulate that you can't have bought a house in Australia. Some of them you can even have bought a house, but it has to be at least 10 years ago. So they are trying to help, and anything that's overseas, yeah, we don't have to worry about it for first home buyer benefits at all. The big one really is your permanent residency. We've got to get either a citizenship or a PR in place to qualify for that.
So I guess if you are on a temporary visa or a sponsored visa and haven't quite got that PR yet, it might be in your interest to continue saving for that deposit and just wait until that PR comes in. Yeah, absolutely.
Yeah, which sort of comes back to the other point we were talking about before. Like, if that's going to be the driver, if we know that we need to qualify for some of these first home buyers grants or schemes or whatever it is, then we need to put the PR up the top of the to-do list. It's going to take time, so get the wheels in motion as soon as you can.
And this last one is from Rob's. What is the best way to save for a house in Australia?
Yeah, there's a couple of different ways you could save. One of the benefits we've got here is if you can qualify for any of these first home buyer benefits, there's one called the First Home Super Saver. And so this is where the government will actually allow you to put up to $15,000, I believe it is at the moment, into your super. So that'll be a concessional rate. So you'll get, say, 15% tax on this money. You put it into your super. It can then grow with whatever your portfolio is growing at the time. And then when you're ready to buy a house, you can actually take that back out again. So normally they won't let you touch super, but this very specific one, that'll help you get a bit of a boost. Aside from that, you can start to look at different investments and things like that. We're starting to get a little bit risky because we can go the other way. You might start to lose some of that savings. The big thing always sometimes sounds a little bit simple, but the big thing is to figure out actually what we need to save and then work it backwards. What does that mean per week? Just do it on a weekly, regular basis and get into the habit of that. If we can set that goal and that timeline, that's going to be your biggest driver. The psychology of knowing exactly what I need to do every single week to get to that target. So I always encourage, as one of the first steps for any first home buyer, it's always about the budget, figure out where we are, figure out where we need to be, and then we can plan accordingly to that. And that's where we can help. We can do all those different scenarios, the planning, the numbers, the strategies.
Thanks, Ben, for talking to us today, and I hope it's given you all a greater insight into the buying process, particularly for new migrants to Australia. If you want to have a conversation with Ben or you need more advice about buying property in Australia, then make sure to check him out on his socials at Track Financial. I've linked all of his information into the description below. Or you can speak to us directly yourself and we can pass your details along. And if you want to see more of what our life is like in Australia, then you can check our YouTube channel out at That Johnston Life. And if all of this information has helped to inspire you to want to make the move too, and you're at the very beginning of your process and you don't know where to start, make sure to speak to our friends True Blue Migration Services, mention us and let them tell you for free the easiest way for you to live out your dreams down under. Follow the hundreds of positive Google reviews and the people that we've directly been able to help through our channel at www.truebluemigration.com. Or perhaps you've done a working holiday visa to Australia and you want to know how you can get back here. Well, watch this podcast. See you soon.